Hello, welcome to this introduction video to basic investing. In today's video, we are going to focus on bond versus stock market. By the end of this video, you will learn what are bonds, how they can benefit you on your portfolio depending on your investment timeline. And third, we will be discussing the differences in recent years between bonds returns and stock market's return. Without any further ado, let us go ahead and dive in. All right, let's go. I prepared this little deck on here, just slide. Okay, this is better in presentation mode. Okay, so what are bonds? Bonds are things that you may heard about if you have a 401k, and typically even, let's say, in a basic knowledge, the story it's you need to have a ratio of bond versus stock. So but people typically do not really have a strong idea about what are bonds. So here, let's take the time and explain it in layman terms on here. So bonds are loans that municipality, countries, and corporation they issue. So as an investor, you investing in a bond is actually you're buying a debt initiated by one of these entities. Yeah, and here's the thing. Let me give you a basic example. For instance, let's say your city, because this happens a lot. Yeah, your city has a plan for, I don't know, a park, and they need to raise money. So they will go to the bond market and issue a bond. So you or other investors across the land, they will then look at the consideration of this bond. The first thing that they will look at, what is the maturity of the bond, meaning how many years, because it's a loan, yeah, how many years is your city saying that they are going to be paying back that loan that they're taking from investors. It could be, typically you will see things like 10 years, 20 years, 30 years. That's what you see typically. And on your 401k, if you have one, you typically will see something of the type, some type of term, something, an investment with a term like 30-year maturity, 20-year maturity. That's what they're referring to. Yeah, this on here. And we will come back to that in terms of the rate of return or yield, if you will, right? So yield, they also call it a coupon rate. Could be 5%. 5% is attractive, and we're gonna find out why that's attractive or anything. And then the price, so meaning this is the money that you as an investor, right, you're going to be giving this, let's say, your municipality or the country, let's say in case of US Treasury, for instance, or corporations. So you could be wondering, why do corporations come to the bond market when the stock market is there? We will dive a little bit into this, but let me tell you why, right? So they can issue a stock, a corporation can issue a stock, but what happens? By issuing new stock, the current existing stocks will lose a little bit of its value. Yeah, because the current investor who already own the stock, and that's happened, we have seen that before. They call that second offering. So that's not something they are bound to do a great deal, and because that will impact, let's say, the balance sheets as well. Yeah, so hence they can come here to in the bond market. So for you, a bond from now on, you know it that, hey, you're buying a loan that one of these institutions has issued, and what's attractive to you on there is this. That is the part that's attractive on bonds, right? So what's going to be happening? Let's say you bought this at $1,000. Every single year during the maturity, so 20 years for instance, they're going to be paying you 5%. So that means in this case $50 every year. Yeah, so that's a guarantee, kind of, if you will, right? Compared to the stock market, where it could have its up and down. We're going to look at the history of the stock market and the return, so to see really where the nuances are. But for now, for us on here in this learning on bond market, so you have your bond, you bought it, the yield is 5%. So every year, your city or the country that you bought it from, the corporation, they are going to give you 5%. And then at the end of the period, you get your cash, your initial investment back. So that's the basic idea on bonds. Now, what is this? All of this is fine and dandy, but there's this thing on here. Can we? Yeah, we can see these are rated. Yeah, the bureau that rate them. So you have Moody's, S&P, and Fitch, for instance, that I use as an example on here. And actually, I think we need to do a better job on that to bring it close. So let me go here and maybe take a version of, yeah, okay, here we can read it better. Yeah, sorry about that. So they have ratings, so meaning that the higher, so they have a rating that goes AAA, AA1, AA2, and so forth. That's good rating. So prime bond, high grade. So, and then you have heard of the word junk bond. That means that the rating is not so good. Let's say all of these here are below non-investment grade. B's, then you are talking trouble. C's, so some of them they consider speculative or default, because yeah, your city could say run out of money because for whatever reason, or the country can run out of money. That is, we're gonna be bringing you examples of the like, meaning, yeah, there are those examples. What countries possibly could run out of money? If so, emerging countries mostly. We have had recent examples. We're gonna be bringing you those. But here in this understanding the concept, so that's what could affect this on here, because they can default at any moment. Just say sorry, we can no longer pay. So that's the risk. But compared to markets, stock markets in general, and we're going to talk about why, here you have this fixed 5%. Now your question could be, but the stock market returns has been, yeah, not so fast. We have the curve in the next slide as we're going to be showing you. Yeah, the stock market does not always do what has been doing recently. Yeah. And we are going to actually compare the return of the yield, the general yield, let's say the US Treasury for the let's say 2, 10, and 30-year bonds to see what type of return they have been getting lately, and then we can compare that to the stock market. They definitely. So bonds are, that's, I would say some people will call them boring, just boring, because not much happened really if it follows back. You're getting your 5% or whatever that yield rate is, the coupon rate is, every single year. That's it. Your money is growing. So in this case here, in our example, so $50 every year until the maturity of it. So, but and make it safe, attractive, yeah, but also it's boring because maybe some other stocks in the stock markets could be going further than that. Is that possible? We can take a look here. Before we go do a comparison, for instance, we're going to compare, let's say the last 1 year, because we had that recent data. Let's share this with you here. This is data that we took of SPY. What is SPY? SPY is the US S&P 500. It represents, it's a basket, if you want, of stocks. Yeah, the 500 most important stocks in the US. They are divided into sectors. So meaning, for instance, you need to know that, hey, if you invest in that, we haven't defined an ETF for you. An ETF is an exchange traded fund, meaning they put stocks together inside of a basket to generate this vehicle. So that's the SPY is the most famous ETF because it has 500 companies, but they are not weighted equally. This is very important. We're going to be talking about it a lot. Meaning, when you invest in SPY, you need to know, for instance, that means, I can tell you that if when you invest in SPY, that means you're investing in Apple. Why? Because the investment, I'm going to my basics here, folks. So I'm going to give you the exact percentage as they stand right now. So I will make sure that we flash them on the next episode. So when you invest in this, for instance, this is when people are talking about the market or SPY, because the broader markets, it has 10 sectors and have over 100 industries. We can actually show you that. So those will each have its performance. So we're gonna, over the next few episodes, we will be thinking, okay, you're investing in the stock market, but there is a way to look at different sectors, different industry to say, oh, my focus is on that. We're actually gonna be a comparison here between SPY and the technologies ETF, for instance. You will see huge difference. So, but when you're investing in SPY, for instance, know that means you're investing on Apple, Microsoft, Amazon, Facebook, Google, Johnson & Johnson, Procter & Gamble, Nvidia. Those that are just quoted at the top 10, they account for a good, let's say, 12, 16, 18, 20, good quarter, or almost 30% of this ETF. Yeah, but is that a good thing and a bad thing? A good thing for that is that you are diversified. That's that word, right? So the bonds are an opportunity for you in your portfolio to say, oh, I have X% of bond, X% of stocks, meaning, okay, my risk is not all in the stock market. Great. But even inside of the stock market, you can diversify yourself by having risk exposure, meaning how much money you're putting in each one of the sectors. There are 10 sectors or in each one of the industries. Yeah, that's really the main takeaway. So over the last 10 years, folks, this is what the stock market, a broad stock market through SPY has done. Yeah, this is huge. This type of return. So from $100 here, it's just, yeah. So $100 goes to $200 by, let's say, 2015. That's 100%. Yeah, it goes to $300 where we are right now. That's over 200%. So, okay, but my friend, what has happened all of these years here? This is 10 years here where not much, the growth, the recent growth that we have seen out of the stock market was not the same. Yeah. So let's go look over this timeline. How has the bond market behaved versus the bond yield, if you will, right? Has behaved versus the stock market, and this is that comparison here. So what am I doing here? Let me duplicate this and do that for you. So let's come here. This is the same chart, the chart of SPY, if you will, but I can come here and say I want to see the US Treasury 10 year, for instance. So that's the bond issued by the US government that has a maturity of 10 years. What has been its yield? Yeah. So if we go US 10 here, let's say US government bond, yeah. So we want to plot its yield. Okay, folks, you ready for this? Because this is, okay, so this is telling us that in 1981, for instance, the yield, meaning that the coupon rate was 13%. And as time has been passing by, let's start in the 2000s, yeah? Let's start in the 2000. It was still interesting. 15. How much here? This is in percentage. So the yield was about 5 to 6%. And look what has happened. This is monthly. So recently, as of now, we are in 2020. This yield is less than 1%. So the other thing to know, that's how you can obviously you may have guessed, is that the longer the maturity, the higher the yield, meaning that, for instance, so we are looking at a yield of what, 0.8% on the 10 year. Let's take a look at the 30 year. So we're gonna go US 30 year, US government bond 30 year yield. Yeah, this is it here. 1.57% more precisely. And to confirm the wish that we just mentioned, that the longer the maturity, the higher the yield, meaning the more you make your money, the longer you make your you lend your money to somebody, the higher the return. So let's say, for instance, look at the 2 year yield. So meaning it needs to be lower than so US government, this is the 20 year. Yeah, this is the 20 year, for instance. So 20 year yield, do we have this here? It's 1.3%. So 30 year 1.57%, and 20 year 1.3. And then what did we say for the 10 year? For the 10 year was less than 1%. Here you have it. So that gives you some idea on that. The longer, here we go. So 0.8 for the 10 year, 1.35 for the 20 year, and 1.57%. So 1.57%, okay, for the 30 year. For the stock market, in the meantime, as we saw on the other graph, has been moving further than that. So for instance, the stock market here over the let's say, yeah, 10 year on here, the stock market, the broad market has gone up 200%. So you divide it by 200%, divided by 10 years. That's 20% per year. Yeah, 20% per year. We are comparing here. At best, the 20 year on here has been 1.3% per year. That's what people are more drawn, because as an investor, you want the biggest profit, right? You will make a decision to say, oh, maybe the majority of my assets are turned more toward the stock. But again, we saw the chart, right? So let's bring it again. This wasn't the case here in the 2001, 2008. The stock market return was not that great. Yeah, they have really accelerated recently over the last 10 years. And conversely, at the time, between 2001, the bond market was having return that were 5% and above. So we say that as the stock market has been generating excellent return, we can say that 20% a year is a lot. I see, even so, then it's not, that's an average now. That there were year, I remember when you look at my 401k in certain years, 36% of the life. Yeah, mostly on the stock side. But the bonds, we can see here, they used to be 6% at the beginning of the 2000s, and they've just been declining. So we see that inverse relationship between the bond market return and the stock market return. That's really that. The other thing to know about the bond market is that when interest rates start going up, the bonds go down, because interest rates are the cost of borrowing money. But if you have a fixed bond that you are getting the same thing, when interest rates get up, meaning the cost of borrowing money did become higher, well, obviously your fixed rate is worthless. That's another fundamental principle to get out of this. All right, so let's see. So we talked about, we define what a bond is, how it can help you depending on your timeline. So meaning, and when in those type of investment portfolio, typically you will just see the maturity of it. So you pick a maturity that corresponds to, let's say, your retirement timeline. Yes, and then set it up like that. So those, and then in this case, the yield or the coupon rate, it's what you will be getting in percentage each year. And the rating can change at any given time, because let's say that there are some tumult, some on social unrest in some countries that you bought bonds from, yeah, or or maybe that's because I can't think of, I hate to say that, but Argentina recently has been in the news, in the financial news for having issues. And then there are others. We're going to be bringing you a lot of content here on investing in general. So this is the basic things on here, that a lot of concept that we definitely are bringing forth today. So, and then we compare, let's say, recent return of the market. But oh yeah, the part that we haven't done. Yes. So now let's say we have this, right? So this is the return, let's say, of the US 10-year yield. Yeah. Now we can compare that to, let's go ahead and compare that. And to compare, I'm gonna click on here. I already plotted it, but I can compare that to this, the broader markets, and then just the technology sector, which is known as the NASDAQ. Yeah. Let's actually click both. This is what has been going on, folks. In red, because I already know that this is the technology index. Look what it has done. This is the broader market with the 10 sectors, the 500 most influential companies. And then this is the yield, the 10-year yield on here. So over this, so you can compare this as you will, right? Like when we came too close on here. In recently, let's say 2009, look what has happened. The technology has been the leader overall across the board. The broader market, yes, has been going up, but yeah, and then the bonds definitely, as we saw earlier, they have been declining. All right, this is conclude the first part, the introduction to our investing basics. So we brought you today on this episode, bond market versus stock market. We hope you took value onto it. Please subscribe. Going forward, we will continue to cater the content of this channel to your liking. Bye bye.